All right, let's make sure our sound is on. All right, guys, good morning. Good morning. Welcome aboard to the Morning Note. My name is Carlos Garcia, founder and CEO of GAR Capital. It is Thursday, January 19th, 2023. Hope everyone's having a nice, lovely morning. It is 9:03 Eastern Standard Time. Time to get started. Before we begin, bottom right-hand corner of your screen, there's a little black logo. Click on that, turn on notifications, subscribe to our channel. Make sure to like our videos. Appreciate it as always. I did a quick minute recap of the morning as we got news in and everything like that. Within a minute span, it's really hard to kind of put everything together and do an intro like, hey, good morning, yada, yada, yada. Instagram tends to favor reels. So again, any way I can get the information out to you so you actually could see it is really important. So again, I missed one little part on the video this morning, the actual reel I did on Instagram, which was Mester and Barkin. I think it was Barkin. God, I'm gonna butcher that Fed name. Let me see if I can get it. I think it was Mester that spoke yesterday, and I want to say Harkin. God, there's so many Fed speakers, and sometimes the names kind of get away from me. I want to say it was Barkin. So let's just say Barkin. I'm gonna probably butcher that name. It was Barkin and Mester that spoke yesterday. Granted, just want to make this very, very important part regarding the Fed speakers yesterday. They are not Fed voters. So again, they can say whatever they want. That's fine. But again, they are not Fed voters. So when non-Fed voters are speaking on monetary policy, take it with a grain of salt. I'm not saying it doesn't matter. I'm just saying that they're just not voters. That's just it. So let's go ahead and go over the futures. Futures are off the lows this morning. Dow futures down about 210. Nasdaq futures down about 83. S&P down 0.66%. Russell down about 0.65 this morning. Crude oil is up this morning 0.43. The dollar is down 102.23. We'll chart that here in a bit. Treasury yield starting to bounce a little bit. VIX, again, we talked about that support level around 19-ish on the newsletter we sent out last week. We talked about the scenarios, bullish and bearish, and what's bearish. And again, you buy protection when you can, not when you need, right? Kind of volatility protection. We talked about that yesterday, that we got to that trend line. I said yesterday that if there's any kind of stock that you want to just get rid of and you're just tired of it and you're over it, that was the point to sell it. I did catch QQQs in the morning, so we caught that before the flush, at least that. Pretty choppy, short week, hate it, but that's where we are. The two trades I had from last week, JPM and Boeing, did not work out. Value was rotated out in favor of more high betas and tech, so I had to eat that this week. But that's just kind of the name of the game. One more piece that I did not speak about on the 1 minute little reel. Again, I can't fit everything there. OPEX. OPEX is tomorrow. This is options expiry. Now you probably say, oh, every OPEX was red, and that's not true. I believe March was green. There was some green out there, but for the majority part, the last 12 months, as I was looking at it, the majority of the time it ended red. Most of the time it was just big range candles on the daily on those OPEX days. So I would just keep that with a grain of salt. You're just going to get increased volatility. Not exactly, oh, the world's going to end, we're going to fall. Not exactly. But again, things may have gone a little too high too fast, and that's completely normal when you get a short squeeze, when you get a little bit of hope or some positive news, you get a boost up. And then again, probably the most popular trend line in finance right now is this downward trend line, which was rejected again. So 40-40 being the case. Taking a look at gold futures, up 0.43%, 19.50 an ounce. 15 an ounce would be kind of hovering around that 1900 level. Gasoline futures up 1.38% at $2.55 a gallon. Copper futures are down 0.55%. Silver down about 0.90%. Euro dollar continues to grind a little higher, up 15 pips. Dollar yen down about 53 pips. We talked about that yen correlation. As the yen strengthens, we expect yields to continue to go down. We'll take a look at that chart as well. Pound dollar pretty much flat. Not all is lost, I guess, in the sense of risk, because Bitcoin and Ethereum are green. Of all things, right? The riskiest of all assets, in a sense, is crypto, and yet they're green today, thanks to the dollar. So let's go ahead and take a look at the S&P 500 futures, my favorite, on the 2-year daily candles. Again, that 3,900 level, we talked about that about 2 weeks ago, where that was the level, the breakout level that we wanted to do. So really you have two scenarios here. Either we're just going to retest this 3,900 and see if we hold, which is lining up right with the 20-day, which is our momentum indicator. If you're below the 20, you tend to fall a little more. If you're above the 20, you tend to rise a little bit as well. So again, as long as we really hold that 3,900, that 20-day moving average, again, looks like it's just a retest ahead of OPEX. A part of me says, hey, this is just an OPEX retest, fine. But again, if that does break 3,900, then it gets really, really interesting. And you do have, again, an upward trend line right at the 100-day, right at 38.79. So again, you could see higher lows, higher highs, at least on the short-term sense. So again, has this really changed anything? Not in particularly. I said it yesterday, this is not an investable market as of yet. It is still too very binary, very close to that trend line. You have the Fed coming, you have earnings, we have Netflix earnings today. So again, I wouldn't want to go ahead and put fresh capital into it unless it's an IRA yourself, like an IRA that you're trying to set up, or you have a Roth IRA or traditional. That's fine because that's a little long-term, you have to be. But again, if you're just have a brokerage account and you're looking to see where you can generate some alpha, it's not to be seen yet, at least in US equities in terms of the broad-based indices. So again, you're still right above the 20. It could be just a retest of that support that we broke out of on just about, we'll call it 2 weeks ago. And that was the one that we talked about. Once you break that 3,900, where we're taking a look at that trend line, we could reject. I expected us to break above it. We did not. So that's another failure. Doesn't mean we can't. It just means that we haven't broke it yet or ever, for all we know. Obviously, eventually we'll probably break it. But again, we're talking about the timeline of the next couple of days, weeks, and so on and so forth. So again, 3,900 being the key level, that's what we're looking for. If you break 3,900, you're really targeting 38.79 for the next support. That'll be support level 2. If that breaks, you got all the way to 3,800 and possibly to 37.45, which is completely technically sound, at least at this juncture. But for now, again, we're getting a little bit of a boost. We had some news that came out. Labor market's still relatively strong. We had what did we have? The unemployment. Where was this? The unemployment claims, if I can find that for you guys. We have the Davos stuff in Switzerland. So again, a lot of speakers, a lot of chatter. Continued jobless claims, 1.647 million. The forecast was 1.655 million. It is still higher than previous week, but again, it's lower than forecast. So again, labor market is still relatively strong. Jobless claims, that was the continued jobless claims. Jobless claims for the week, 190,000. The forecast was 213,000. So that's a beat. And then the previous week was 205,000. So again, we're still falling. Even if we're getting layoffs in the tech world, we're still seeing labor still holding up. And again, if people are working, people are spending. So again, that's inflationary, mind you. US Philly Fed Business Index, negative 8.9%. Forecast is negative 11, so that's a beat as well. Building permits change month over month, negative 1.6%. The forecast was 1%. That's a leading indicator for real estate. We talked about the mortgage applications yesterday. The majority of those mortgage applications that were pretty much 25-fold of forecast was really refinances, which really goes into kind of the thesis that we're looking for, that lower rates are going to pretty much lead us out in a sense, because of the fact that as rates go down, with treasury rates, we'll get lower mortgage rates, which gives people an opportunity who bought in 2022 to refinance to a lower payment, which adds to more savings and again boosts the consumer's balance sheet. But we need to fall a little bit more. Let's take a look at the 10-year TNX. And again, we're right there, right at 33.03, pretty near it, about 100 basis points away from there. That's pretty much what we're about 50 basis points, 33.03, 100 basis points away from 33.03, which is the 200-day moving average. If we break that, then again, we're taking a look at 31.43 and so on and so forth. Again, so far this head and shoulders has played out. We did retest that line here, that shoulder line, and then we came back down. So again, as rates go down, that is going to be a boon a little bit to the higher betas, the companies that are trying to borrow money or possibly refinance, or consumers that are trying to refinance their homes. at a lower rate that bought in 2022. If you bought a house in 2021, you're pretty much probably not going to refi for a while. You probably locked in a really good rate, especially in 2020 as well. So again, taking a look at TNX, again, we see that 3404 support. We expect that to continue to fall. And again, 3313, that's the 200-day moving average. That's what I'm looking for a break. Nothing good happens below the 200-day, as we've been stating. If we're talking about kind of a longer term goal, if anything, of what we're looking for yields, it's really to recapture this trend line around 24.54. That's a sub 3. That's a very tall task. That'll get us back to levels not seen since around April of last year. As inflation has peaked in June of last year, I think that we revert back to the mean, get us back to around 2.6% on a 10-year. That should get us to around maybe 5, maybe 4.9, maybe 5.2 on a 30-year mortgage, which would be pretty helpful to homeowners that are looking to refinance. Let's go ahead and take a look at the dollar index together. Dollar index still very, very weak. You can see 101.62 is still holding up. I still have a target of sub 100, at least by the first half of 2023. That's going to help at least on certain aspects. So again, a couple of things that came to mind talking about earnings and looking at earnings as we prepare for earnings season. A couple of things are working in the way of these companies. PPI, again, is below CPI. That's a really good sign. What does that tell you? That means margins are going to be stronger for these companies as cost of goods are going to go down in terms of the producer price index. Now, when people saw the producer price index, it doesn't mean that the grocery stores are going to run straight to the egg aisle and change their prices. It doesn't work like that. Most food items out there are commoditized and they're based on futures prices, futures contract prices, whether it's hog, whether it's milk or cattle, all that good stuff, corn, you name it. So again, that's the futures market, just kind of like oil. So again, Walmart is not looking at the PPI number today and say, hey, we got to go lower prices. No, they're going to keep prices where they are until they see demand wane. And again, as long as people are employed, they're going to spend. The only way you're going to get really lower prices in terms of a generalized lower price where it becomes at least, sustainable, you need to have employment go down, unemployment go higher. We need demand to keep falling. Now, we did see retail sales fall last, we had that reading yesterday, but it's still not enough at least to get us to the inflation or demand inflation to go lower. Guys, there's a big difference between monetary policy inflation and demand inflation. The US has demand inflation. Again, this is what happens when you have high employment. Again, it creates inflation to get really, really hot. So we're kind of in a weird place. The Fed keeps talking about 5%, 5%, 5%. And no matter what the data is, they're going to go to 5%. That was, I believe, Mester yesterday. And again, they're not voters. What matters is not what they say, is how the market reacts. And I think the market doesn't believe the Fed. They keep saying that 5% level is their target. Kind of like the 2% inflation level is their target. But if we go to 10-year bond treasury futures, and again, this is not yields, these are bond prices, you could see the 200-day right there at 124. That's really the level that we're looking for to really get yields to start going down. Yields and bond prices move inverse from each other, always. So again, we did break out of this yellow line resistance. Now we're looking for that 200 MA. If we can get above there, then we could start seeing interest rates really, really falling and be a nice boon for the markets. Let's take a look at high yield credit. Rejected that 61.8 fib right at 76.86. We do have a gap to fill at 77.61. Not a lot of action on terms of HYG in the options market. I'm not seeing a ton of volume out there. It seems to be very concentrated on just a couple of names. Tesla, Apple, the big tech names, the ones that have been beaten down. But oil names, XLEs, consumer staples, if you want to short or something like that, the volume just isn't there. We don't have enough volume yet to get there. And again, it is still the early part of January. As we get earnings coming in, the Fed on February 1st, then we'll start seeing a little more volume as we go. So again, it's no need to just go get crazy here and start buying everything and just take on the market. You really have to be pretty tactical because it's still pretty binary as we rejected that trend line on S&P 500. But again, if we get above 76.86 as we did yesterday, We have a gap to fill right here, right around 78.25. Another gap to fill at 77.61. High yield credit is basically for companies that need to borrow money that will pay a little higher interest. They're not investment grade. B's, double B's, triple B's, those kind of names, as you guys probably seen The Big Short and how it goes. So high yield credit is showing at least an increase in liquidity in the market, capital markets. If we take a look at investment grade, again, this is Johnson & Johnson, this is Microsoft, Apple, the big names that have the money. You could say AAA credit or AA credit, 112.36. That's the gap to fill that we're looking for. We could always reject that, but at least the good news is we're above the 200-day MA. So really the level that we're looking for to really get us out of this in terms of the downside action, where bonds will lead the way out, as I said, is really right around 115.25. So a little more to go on LQD. Let's go and take a look at the volatility index. Again, we talked about this support. Not only we tagged, we broke it. It bounced. Now we're below the 50-day, but we're now above the 20-day. So again, momentum is to the upside on the volatility index. And we talked about that in the newsletter, where you buy protection when you can, not when you have to. So again, protection seems pretty cheap right now, right around 21.55. Again, we talked about that on the newsletter as well. If you didn't sign up for the newsletter, make sure to take a look at our website, gar.capital, gar.capital. That's it. That's all you have to type in. And then you sign up for the newsletter. And we talked about kind of the scenario or the actual good setup where you buy stocks at VIX over 35 and you sell it below 20 VIX. And that seems to be kind of working, at least in terms of that S&P 500 trend line. Let's go ahead and take a look next at crude oil, which is kind of beholden to the dollar. And again, it's still downward. It's not like, we've broken out of anything really special. You need to really get above 84.71. Again, energy companies are fine, but for the most part, you're really just looking for value there. Value stocks have been bidded higher in 2022 due to the interest rate shock and inflation shock. But again, it's starting to get a little long in the tooth. If you have value names and you're just looking for continuous dividends and that sort of sense, not very much volatility, then that's fine. But if you're looking for generate alpha, at least for the next 5 years, value is a little overbought in comparison to growth. Doesn't mean you should go ahead and buy growth today, but again, it's something to keep in the back of your mind. So 84.72 on crude oil, that's really the level that you're looking at. I mean, we've been kind of staying within 75 and 82 for the past, couple of days, or 75.80. Not a lot of edge there, and this is where crude oil is, from 130 to around 70. That's where we've been pretty volatile itself. Let's take a look at good old Bitcoin, crypto. You do have a gap to fill on the daily. We still need to get above 232.54. That's your 200-day. So a lot of this is really just noise. If we can get at least a boost above the 200 MA, then we can start taking a look at possibilities of this gap fill to 28.807. So with that being said, so much stuff going on. Keep in mind tomorrow is the OPEX day, options expiry. Now it depends on where we're going to go. Could you short it? Could you go long? I mean, do we really want to do anything here, especially in a binary event with the end of the week? Not really. So again, we'll see if we break 38.79. If that does, again, that could reverse tomorrow. We could reverse this today and then drop tomorrow. There's so many scenarios here, but what I do see is that this range is getting tighter and tighter and tighter. Something has to give. Either we're going to break out of this trend line to the upside, or we're going to break down of this higher lows setup here. So something has to give right towards the bottom end of that support. Let's see where we go, but let's see if we get any news, or at least good news, in terms of one company in particular. That is Netflix. That is high beta. That is a name that will take advantage of HYG and lower interest rates, high yield credit markets. So again, gives them an opportunity to invest more into their business, maybe into more production. But again, that remains to be seen. The good news with Netflix, at least on this, the dollar going down is going to help their bottom line. So I expect EPS to be a little better than expected, at least them to mention the dollar being a good tailwind to their EPS bottom line. So again, I think Netflix, I don't know what their earnings expectations are. Again, I'm not sure, but again, we'll be watching that today after the bell. One more piece of information. We did have Procter & Gamble, which is a value company in itself. Procter & Gamble this morning is 143, about down this morning. Procter & Gamble 2023 Q2 earnings. This is their fiscal Q2. 20.77 billion in net sales. That's a beat of 20.74. Core EPS, earnings per share, $1.59 versus the estimate $1.60. So that's a miss by a penny. Healthcare organic sales up 8%, estimated 7.7%. Organic revenue 5%, estimated 4.83. Raises sales growth outlook. I expect that as PPI goes down, because if the cost of goods go down, that means their margins go higher. If their pricing remains the same, Procter & Gamble says that they're going to have, they increase their sales forecast. That's a good sign. Don't see really much why the market is really selling this off, other than the fact that Procter & Gamble right now, at least in before the number that we just got, on a forward PE basis, Procter & Gamble is trading at a 23.32 price to earnings multiple, which is pretty expensive. But Procter & Gamble is now more expensive than Apple. It's more expensive than Microsoft. It's more expensive than Visa. It's more expensive than Berkshire Hathaway. It's more expensive than Qualcomm. It's more expensive than Broadcom. I mean, names that are showing growth to the upside, where Procter & Gamble, again, they're pretty flat. You can only sell so many soaps and shampoo and razors. Again, those are staples. But again, look at yesterday. Consumer defensives took a hit. They were the worst performing sector yesterday on the one-day relative performance. The defensives, see the week on the 1 week relative performance, they're down 2.64%, and that's generally dictated by the 10-year yield. So the 10-year yield goes down, you're going to see a rotation out of defensives, out of staples, into more growth, because the cost of borrowing goes down. So always understand that macro before you take a look at the market in a broader sense. All right, guys, we'll go ahead and leave it there. Have a great rest of your morning. We'll be watching the market as always. Keep an eye on that 3,900 level on the S&P, and have a great rest of your Thursday. We will see you tomorrow for the morning note. Have a great rest of your day. Cheers.